Hello, and welcome to episode 23 of the Big 5D podcast. I'm your host, Charles Laughlin. We're all about talking to the companies that are making it happen in the small and local tech ecosystem in Africa and the Middle East. Today's guest is Tariq Sheikh. He's founder and CEO of PostPay. PostPay was formed in 2019 and it launched its Buy Now, Pay Later product in 2020. Around the same time, a bunch of other companies did the same thing in the Gulf region, mainly in the UAE and Saudi. Now, MENA is a highly competitive market and kind of a reflection of the global buy now, pay later market, which is, of course, all over the news and hyper competitive and attracting big dollar M&A. The greatest example of this was Square's acquisition of Afterpay for $29 billion. And we just saw PayPal acquire a company called Paydi in Japan for about $3 billion. As a quick aside, Afterpay is an investor in PostPay. We've also seen many smaller regional acquisitions. For example, Zipco, an Australian company, recently acquired the remaining shares in Payflex after making an investment earlier. And it acquired Spotii, a UAE buy now, pay later platform that continues to operate under the Spotii brand. So there's a lot going on in this space, and we really wanted to get somebody on the podcast to tell us all about it. So Tariq was kind enough to come on and answer all our questions about how the business works, some of the challenges it's facing, the competitive environment, and so on. So we really hope you enjoy the podcast. Tariq, welcome to the podcast.
Thanks, Charles, for having me.
Great. So your company, PostPay, is operating in UAE, Dubai. We'll get into a lot about what your company does. It's in the buy now, pay later space, obviously, which is a very active space. Lots to discuss there right now. But let's go back to the beginning a little bit and tell us a little bit about your background and what led you to this industry, which seemed to have come out of nowhere in at least in the Middle East over the last few years.
Yeah, I mean, it really has come out of nowhere globally. I would say. So I used to be. Well, I'm not going to go all the way back right to the beginning, but start off in my entry into the Middle East, which was several years ago. I actually moved here with a consulting firm. I used to be a strategy consultant. And I moved into the Middle East, worked in both public and private sectors, various number of projects, mainly in the UAE and Saudi Arabia, and a number of other countries here. I started obviously to really immerse myself in the culture, immerse myself in the region. But over a period of time in consulting, I started to hit a plateau. The learning curve tapers out. You start repeating things, and it was one of my intentions. During my MBA, I did an exchange in Spain at ESADE, which was a wise choice. It's a great city in Barcelona, and yeah, it's a great place. And I was connected to a community of essentially it's a mid-market private equity instrument called a search fund. And so I ended up deciding that, I'm going to pull the plug on consulting and I'm going to do something a little bit more bold. I'm going to move from strategy and operations and put a hat on as a fundraiser. And I'm going to open up this door, something that I always wanted to do. So I actually moved focus not only from the Middle East, but also to, North Africa, East Africa, and even South Africa, really from a high level view to understand where I could operate. And I started honing into a specific region, which was East Africa. So I actually started in a totally different region, working on something totally different. Mm-hmm. And it's interesting because you have so many entrepreneurs who start out, and there's a fine line between perseverance in the wrong direction and pivoting, right?
Right. Yeah. You need to know when it's not working and when it's not.
When it's not working.
Yeah.
Exactly. And so, transitioning through this role, this new hat that I had put on, and practically I was looking for investors globally. um, from all different types of channels, sending emails, calling them out. It was, in retrospect or in hindsight, quite a bold thing to do. And I mean, I had to wear my heart and soul around around an armor, because there was a lot. You put yourself on the line. You really put yourself on the line. And I reached out to investors globally for a search fund that was going to own and operate private companies and consolidate an industry in East Africa. I started building some really strong relationships with investors, and it was an incredible experience, because these are people who have their finger on the pulse. They know what's happening in multiple markets, and it's, I can read the Financial Times every day, or watch the news, or listen to podcasts, right? And often, more often than not, we miss a lot of what's happening next. It's always what's in the present.
Right.
And these types of investors, I've obviously got a huge respect for them, because they are in the know. They know, and they have a sense of what's happening. So I started having a conversation, deeper conversations with investors. And one of the investors had just invested in Afterpay, and they were obviously talking about the huge success of this business in Australia. And I started looking at this model and the applicability of this model in the Middle East and Africa. So this is a wider zone of where to play. And it became pretty obvious to me that it was an industry on the cusp of drastic growth. I know many people say this, and I'm sure I've said this before about other industries that didn't grow. But it was really that feeling that this hasn't happened yet in the Middle East. But we were totally
You've called it right. Yeah.
yeah, exactly.
Yeah.
And it was not easy. I mean, we started off. So it was that very point where I decided to pivot. That was the major pivot. So pivot away from the mid-market, which we had almost closed the full fund, and move to a startup in tech, which I had very little experience in tech, as much as I would want to. And it was that's when I found, when I was introduced to my co-founder, Danny Molina, who was the founding CTO of one of the first buy now pay later players in Spain, Aplázame. And so, that was, I'm extremely grateful to have met Danny at the right place at the right time when we were going through our seed funding. And together we sat down in a co-working space and started building this buy now pay later. Sorry, go ahead.
No, I guess jumping ahead, I was wondering why was UAE simply because that's where you're based, or did you see that as a unique opportunity?
I mean, in true ex-consultant style, I did a hardcore analysis.
I would hope.
It was a huge model, based on, I think it was 15 dimensions that we assessed. When I say we, I assessed these countries and looked at everything from GDP per capita, mobile phone penetration, credit card, debit card penetration, and also just straight out what's the e-commerce market size and what's the retail market size in these countries, and then also a little bit on the risk towards the latter part of the analysis. But it was quite clear that while Africa is always close to a lot of our hearts, and it's a continent that has a lot of opportunity for growth. For e-commerce and for buy now pay later, the Middle East was really where it was going to happen next, and for a couple of reasons. The e-commerce market was booming already. It was large, so the e-commerce market in the UAE was several times larger than South Africa, which was the largest in Africa. Obviously, I didn't look to the US because there were so many players there already. Europe had a number of players. Australia had existing players. And I had no real connection to, the Singapore, Indonesia, Malaysia, and Latin America is quite far out. From my perspective, I was based in the Middle East. Right. And the UAE, why the UAE as opposed to Saudi Arabia or any of the other countries here? Well, the UAE, from a risk perspective, was for us the best place to test the model, to really test the model in the initial period. Because we had a hypothesis at the time that due to the nature of the average order values of our product, and we can get all technical a bit later, but our hypothesis was that it was just too low an average order value for people to default on. And that's essentially why we started off in the UAE, and now we've grown across the region.
Okay, so yeah, there are some under the hood business model issues I want to get into in a little bit, but
Sure.
Just to level set on the where your business is today, and we'll get into the Afterpay investment as well shortly. But where you're operating today, and are there any sort of market launches underway that you can talk about? Kind of just your geographic footprint right now.
So today we are 100% live operational in the UAE. We've really pushed very strongly in the UAE. Mm-hmm. Saudi Arabia is next, followed by Kuwait, Qatar, Bahrain. But really, the geographies that we want to play from, again, it's and you mentioned the investment from Afterpay. It's a lot of the areas or the zone that we consider post-paid territory is where we would like to operate, is anywhere from Turkey to South Africa and from Morocco to Malaysia, Indonesia. We have a Sharia compliant product. It resonates strongly in this part of the world, in the T axis that I highlighted. And so we see a strong fit. Obviously, it's in applicable regions because not all of these markets have the right, that are sizable enough to justify investment.
Right. Okay. So you actually, it should have been right in front of me. I think it was 2019 you launched, or is it 2020? I know that was right around there.
Established 2019 April, the company. Launched in 2020, yeah.
Okay, I think that. So what's interesting is that right at that time, roughly, more than one buy now, pay later emerged. Sort of, I don't know if everyone had the same idea at once or other people were saying, I'm not sure why, but it was like this, several companies, Tamara, there's Spotty, which was acquired, and, a few others, yourselves. So what do you think what is it about that time and that opportunity seemed to gel in so many places? Why were you expecting that, for one thing, and why do you think it happened?
It's interesting. I mean, initially there was absolutely no player in the Middle East, and I'd found a player that had on their website. This is before I actually set up the company, buy now, pay later, but they were not actually operational. So I thought that was going to be a competitor initially, and I ended up getting connected through a friend because of the search fund, Wall, who was at Harvard, and he connected me to someone who was in part of his class, and he was a founder of a buy now, pay later in the UAE as well. And this was, just after we had closed our pre-seed, so it happened very quickly. We were all in the know. I guess I knew that there were at least two other players relatively soon, about 2 to 3 months later. We had started making some noise in the market, but then decided to focus on product launch, product growth. Your question around why this moment in time, I guess it's driven by the market, right? It's clear that it was a success. It was a big, big success in the US and in Australia and in Europe. And the Middle East often emulates, I would say, what happens in the West. Sometimes betters it, improves it, and applies it locally. So this is essentially what happens. So we go back a couple of years to Careem and Uber in the Middle East. It's a very similar style model, but we needed it here. There was a strong demand.
So let's talk about what it is, sort of the beauty of the BNPL model and why it's resonating. So there's a lot's been written about this, but I'd like to hear your perspective on why this model resonates so strongly. And I know you mentioned it's Sharia compliant, so it has a sort of a unique appeal to Muslim countries, but obviously it's big everywhere, and the common denominator seems to be generational. One common denominator. So just Absolutely. Talk about why you think this is just caught on the way it has.
I think you mentioned the major point, right? While I wouldn't say that's only the generational factor, because if I look at the users that we have, a large proportion are millennials, Gen Z, but right. We still have 30%, 25% who are still using it and avid users. When we talk about Gen Z and millennials, this is a population that grew up through a financial crisis, 2007, 2008. a lot of uncertainty. It wasn't as easy. And I'm a millennial, albeit on the other side. I'm not sure. I sort of just cut it into being a millennial, but I grew up in the millennial, really as a millennial.
Right.
And there was a lot of uncertainty in the job market. There was a lot of uncertainty in the banking industry and the financial service sector. Personally, there was a lot. There was a generational shift away from banking and the financial sector. It was almost like a veil was lifted on the complexity or I want to be politically correct here, but the mess that was that had become in the financial services sector, the lack of transparency, the APRs, the revolving the revolvers in the industry. And so this generation tends to steer away. It's a generation that steers away from using credit cards that uses typical financial products or traditional financial products, and prefers to use either cash and just pay for what they have, like the 2 or 3 generations before, and or use buy now, pay later, where it's very clear, this is what I'm doing, this is how much it's going to cost. So there's a lot of transparency, but also the fact of instant gratification, right? So this generation want, a couple of things. One, they want things now, and 2, they want things that are free. And this is it. So, if you sorry.
No, it's just the free part is, yeah, you see that. I mean, I try to sell content and no one wants to pay for content, right? So
yeah, I mean, it is interesting because the consumers want things that are free, and the way, marketing is totally shifted, the way, brought value to influencers who get paid for marketing, et cetera. I would say it's also changed the overall structure of the market. And in the same way, in an even larger way, you had the Affirm style model, I call it, that it existed for a while. This isn't a model that did phenomenally well with a specific average order value. It was specifically over a certain amount. It was interest bearing. It was complex to a certain extent. It was still a lot easier to understand than a banking loan. But there was an APR attached, and not all customers want to start engaging with APRs. Hardly any customers understand what APR stands for in the first place. Right. So the moment we start talking about interest rates, it becomes very complex. What Afterpay did is they turned the model on its head, and I believe that that's when it started to really boom. Right. And I'm not just saying this because we're affiliated with them.
But to be clear, that model it's purely free. It's no credit checks. It's it's
beyond the credit checks or not. It's more about where do you bring value in from the market? Are you getting it from the consumer?
Right.
Or what they did is they shifted those costs from the consumer and shifted it over to the retailer. And it's very much what we do, right? So we work with retailers, with their customers, to offer free buy now, pay later installments. There's absolutely no cost for the customers. And in return, the retailers get a huge amount of value. We've seen tremendous value in conversion rates, so increases in conversion rates, increases in average order values. And it's a really strong top line impact on the retailer, which is justified. It really justifies paying 2, maybe 3% on top of their normal payment fees.
That's actually a good segue into some competitive questions I have about the business. I want to get into kind of what the KPIs are, but what you just said was, getting the money from the merchant, the retailer,
Yeah.
which is, kind of how people perceive this model working, though I know there are different models. Some charge interest, some don't, some charge fees to the consumer. But
Mhm.
but I'm wondering if, as this competitive situation evolves the way it is, if there's going to be pressure, because the differentiator is getting those retailer relationships, right? Is that going to create pressure to give the retailers, are the retailers in a strong position to negotiate, I guess, with buy now, pay laters now, so that they
So
can create, you know,
yeah.
you know what I'm asking you, and does that put some pressure on that model?
So let's talk about, and I'm going to answer the question. I'm going to phrase the question as differentiation, and how do buy now pay later players differentiate in a market that becomes increasingly competitive?
Mm-hmm.
And for me, there are two major buckets. The first one is constructive differentiation, and the second is destructive
Okay.
differentiation. And I think we know where the latter is going.
Okay, but let's
But
hear it.
yeah, well, we'll talk about constructive differentiation. One of the things that we do, and I'm not specifically talking about postpay only. It's whether it's Afterpay, Klarna, Sezzle, Splitit, whoever it is. User experience is one of the key differentiators, right? How you enable user experience, and it's everything from the first point a customer sees you as a buy now pay later, all the way to the end when they've finished, right? When a customer has paid, not paid, etc., etc. It's a long journey, and a lot of buy now pay later players confuse it, right, with UX only online and UX, and then pass it off to third-party collectors, etc., etc. So user experience is really important, and it leads to higher conversion in many ways. The first is obviously less number of clicks, less number of forms, less number of whatever we can cut out, which is the power of being a fintech, if you want, for whatever that term covers. We have an agility and an adaptability to the market that the traditional financial services sector just does not, for many reasons.
Mm-hmm.
But that's a subject for another day. And we're able to do that. So that's the first one, and that's the conversion. And the second is bringing back customers, right? So it's bringing our own customer base to the retailer. It's ensuring that we're able to bring value. So that's also in the overall customer experience. Are you providing a customer experience that's seamless, that is that customers would want to come back and use you? So that's the first one. The second is obviously product and product differentiation. So I mentioned the Affirm Afterpay model. There are use cases for both, right? So you have some entrants to the market that come in and say, look, I've played it a little late. I'm going to go for a niche. I'm going to go for a niche in the longer term installment bearing product, because I believe that this is important for, I don't know, furniture companies or for Peloton or Peloton style bikes, right? And then the third is obviously specific vertical niche. So we see in the US companies like Sezzle that focused on SMEs. They were really, really focused on SMEs. Others are focused on B2B. You get fly now, pay later, education. Right. So there are a lot of different differentiators. That's constructive in the way that you're not, destroying the market. You're going in and finding a niche, lucrative niches. I mean, in the Middle East, in the UAE, the schooling system is, $1 billion business. It's huge. It's a couple of $1 billion per annum. So there is a lot of value to be brought to the market. Destructive competition, traditionally, and this is obviously, I haven't exhausted all the different, differentiation, the constructive differentiation, but destructive differentiation typically comes in two forms and tends to not bode well for any player in the market. And it ends up being a little bit of game theory at the end, right? It's lowball pricing, which is unfortunate.
Right.
It always happens. And it's typically in the unit costs, right? So it's variable fees, fixed fees that we charge as gateways to the retailers. And then the other comes in many different forms, but it could be termed as marketing investments or whatever it is that comes traditionally from. It should be the other way around, but somehow it goes from buy now, pay later to marketing initiatives to boost sales in other ways.
Right.
I'm not a big believer in those two, because I believe in sustainability, right? You want, as a retailer, you would want to work with, and I don't like the term vendor, more a partner.
Yeah, sure.
You'd want to work with a partner who's not, losing money at every transaction, and in having to invest, hundreds of thousands or millions of dollars to win an account, because, the value should be in the product.
Okay, so that's interesting. Because one thing I've seen, and you may not consider this destructive, but it really got my attention, is these cashback offers to get consumers to become repeat customers. I've seen that with, I think it's Tabby, and then I've seen it sort of in some global players. I mean, that's sort of normal in one sense, but it sort of made me think, is the return business what it should be? If it were, why would these offers be necessary? So I'm wondering if you put that in the destructive category, or if that's just part of doing business.
I think it's so I can't directly comment on the cashback business, because we don't do any cashback business.
Mm-hmm.
But I will say that there is a marketing so we fall into a very peculiar position between the market and retailers. Mm-hmm. So any value that we're able to drive for merchants is powerful. For example, we provide a number of our merchants the opportunity to show their discount codes, their promo codes. Mm-hmm. So it's not really a cashback. We're not dealing with any of the cash, but right. We deal with the promo codes. So right. Retailers are investing in a cashback. Technically, it's the same thing as a cashback, but there's no cash element to it. Right. I guess the cashback is very similar, but I would say it's cumbersome. It's not something that I would jump at, because of the simple cumbersome necessity to deal with people's expectation of cashback. However, whether it drives traffic or not, it probably does. It probably does, because people want free things, and if they're getting free cash or they're getting free promo codes, they're going to use it.
Sure. Cash may get more attention getting than promo codes, I think, even though in essence, they're the same thing. Okay, so my understanding of the business, kind of what drives it, and I kind of want to get into getting customers to do this just once and never come back, is probably not great for the business. So you need some repeat customers. You need to be driving higher order values for your partners. What other metrics signal success, other than the obvious growth, but what other sort of under the hood KPIs really signal success in this business?
So from a merchant perspective or from Postpays perspective?
Well, I guess, we could do both.
I mean, they're the same.
Yeah, because in a way, what keeps them coming back and what keeps them growing and in business.
Absolutely. I'll talk about the KPIs or the metrics that we use to understand the impact, the uplift on merchants. And they run through, I mean, they may vary from merchant to merchant, but because based on priority. But essentially you have straight off the bat, you have two major ones, which are conversion rates, right? And AOVs. Conversion rates come from obviously our market, so our customer base, our return customer base using the retailer, and also the fact that the same customer that would not have checked out because the price was too high is now able to check out. Mm-hmm. And AOV impact obviously is that the hypothetical checkout amount is a lot higher. They're able to put a lot more in their basket and and check out with more. So those are the two main metrics.
Okay.
In addition to that, we look at items per order. So this is another metric that we look at, which is similar to average order value, but it also looks at, are they just buying more things or are they buying more expensive things? So it's a nice way to dive down a little bit more. We also look at return rates, so refund/return rates. And that's important because in a region where logistic costs are enormous, and we've had a legacy system or legacy issue with cash on delivery, very, let's say, unfortunate to have had COVID globally. But the silver lining to the storm was that cash on delivery was practically banned for a period of time because of the hygiene and the lack of hygiene, etc. And this led, this shifted a lot of people over the line to use online payments. So with that, we're also trying to bring more value into the market and cash on delivery. So our return rates, we often reduce turn rates between 15 and 25% across retailers.
Okay. All right. So that's how you drive value. And that's how you see if it's working, right? And
absolutely.
Yeah. So in the time left, I want to bring up a couple things that kind of need to be brought up. One is there are some growing critiques of the buy now, pay later space, and that, yes, it's not interest-bearing credit, at least in your model, et cetera, but it is an obligation to a consumer. And there are some growing concerns that, maybe consumers, the fact that they're spending more using this model versus just paying cash up front might suggest that they're taking on a little bit more than maybe they're biting off a little more than they can chew. You've heard these, I'm sure. How do you respond to them?
A number of different ways. First of all, credit, as it were, as a cash disbursement industry is regulated for good reason. And obviously the amounts are very different. When we talk about buy now, pay later, we're talking about $200, $250. At a cap, maybe $300. If we really go far up, maybe $500. But the limits are a lot lower than what we talk about when we talk about credit limits. So even if we go and dig into a credit bureau and the debt burden ratio, $200, $300 is not going to make a huge difference for the vast majority of a population, right? So when we look at it from a consumer perspective, first of all, we're working with our customers, right? We work with our customers. We're not a debt collection agency. Customers are not able to check out with multiple installment plans ongoing if they haven't paid installments off. So they can never get into a situation where they become a revolver. There's nothing like that in buy now, pay later.
If you're going from like platform shopping to take on multiple obligations, is that possible? And is that
so if we end up in a situation where you have 24 different buy now, pay later players, then you can, technically, if they're not all integrated into the same system, then yes, you could end up getting into a situation. So it's definitely noted, and something that I'm also in conversations with other buy now, pay later founders and CEOs on how to bring it together, because I believe that that's probably the next step, is to not only for debt burden, but also for fraud, right?
That does seem like a risk built, especially in a competitive market. If I'm a consumer, I'm like, okay, firm won't give me any more, or whoever won't give me any more money. I'll just, I'll buy my next pair of shoes on some other platform. And at some point, $200 adds up.
Well, it multiplies by however many players there are in the market, right? Yeah. No, it is a conversation, and really that is where I believe it's important to have a constructive conversation with regulators globally on perhaps this level, but it only becomes a necessity when it's put into the context, right? So if people are getting 2, 3, 4 credit cards straight off the bat when they get a job in a country, then it's sort of an irrelevant conversation. But if we are in a situation where there are multiple players and the math doesn't add up, then it's a valid conversation. But we also work with our customers. We work with our customers, and we ensure that people are not in situations where they just cannot pay. We work with them and see how we can support them.
Okay, we'll move on from that. One last couple more quick things I want to ask. I wanted to get into a conversation kind of about how COVID drove the business, but the numbers are pretty clear. It massively drove the business. Right. My sense is that it's not really, I don't see a COVID letdown, because e-commerce has grown and it's kind of stayed. I think the risks to the business are much more around the competitive nature of it and some of the issues with consumers, et cetera, as opposed to like a COVID letdown. Is that how you see it, or do you see it differently?
Yeah, absolutely. I think COVID was just the double tailwind to growth. Yeah.
Okay, we don't have to get into that in any more detail. It's just sort of an obvious point I thought I should at least acknowledge. The other thing I wanted to ask is more of an observation of mine that could be wrong. Happy to be proven wrong. My sense is, as all of these international players come in, we just saw Zip finish an acquisition of a business they invested in South Africa, a company called Payflex, I believe. We've seen the investment in you. It's not an acquisition, but we've seen what happened with Spotty, with Checkout.com and Tamara, and obviously Square Afterpay is massive. One thing that occurs to me is, and this may be silly, are we going to get sort of not serious businesses starting up to sort of lay themselves in the path of these big international players with lots of money? Could that even work? And is that at least a short-term risk to add unnecessary competition to the market? Do you see that? I mean, is that something to even think about?
Your question is whether there'll be people setting up buy now, pay later simply to get acquired by large international BNPLs. Look, I think it's very clear at this point. The market has a number of existing players, and I think it's already got to the point where there's going to be M&A. There's going to be a consolidation of the industry, and or some companies are going to run out of steam. And so to set up a company right now, I don't think large global players would be interested in investing and burning.
I would think that ship has sailed personally, but I've heard this objection raised by others, or this concern raised by others.
I don't think it's a concern. I mean, and at the end of the day, whether from our perspective, whether, let's say, company X, a global player in buy now, pay later, wants to enter the market here, whether they buy out a local player who's got nothing or come in by themselves really doesn't make a difference.
Mm-hmm. Yeah. Okay, that's fair. Final question, and that is, where does this go? And I'll ask sort of a multi-parter on that. For example, you have geographic expansion plans you've already outlined. What about on the product side? There are niche players, and then there are sort of more broadly positioned players. Does it evolve into more of a broader solution for consumers or merchants? Does it go just up market in terms of the average cost? How does this business evolve going forward to continue its growth?
There's so many things in buy now, pay later, so many things that are being addressed, but not only in buy now, pay later and fintech. So I'm sorry, I'm taking a step back and looking at the overall, financial services sector that's being disrupted and challenged on so many different fronts, whether it's savings and wealth management or payments, credit, and those are three. There are many other verticals in the banking sector, three that have, openly been challenged and changed drastically. So I believe that there is a confirmation of buy now, pay later as an industry here to stay. And that's a good thing, not only because we have a buy now, pay later company, but it's a good thing for the customers. It's a good thing because it's free for the customers. It's also a good thing because it's actually driving true value for retailers. So the margins that the banking sector were drawing from the credit industry is starting to fizzle out. And that value is now going towards the merchant and towards the customer. Not to say that these big angry banks have been ruling the world. It's not about that. It's just an evolution of the financial services sector and an evolution of the banking industry. But in certain blocks. So when we talk about buy now, pay later, it's really in the credit space. And so to understand what will happen in buy now, pay later and the evolution of buy now, pay later, we have to look at the credit space, because that's really what we're talking about. What we have done and what we have got today is what some would say, micro lending, short term, focused on specific products. It's really just tapped into a very, very small part of what there is in the industry. There is a whole array of different verticals. So, and I mentioned them earlier, to tap into. There are a range of different products that will also come out from this. But I also am a firm believer, especially in the Middle East, that we're only tapping into a very, very thin share of what is the monster of retail in the region, which is an omni-channel experience. And that's really the next thing for us. It's how to create an omni-channel experience in really a mall culture. We have some of the best malls in the region.
Oh yeah, no, I've been to Dubai. They're fantastic.
Yeah, and so we're not just going to operate online because we have to do justice to the infrastructure that's between the UAE, Saudi Arabia, and all the other GCC countries with these phenomenal malls and experiences. And people love the experiences at the end of the day.
Right. Okay. So in-person retail is another area, and we're seeing more of it. More companies having an in-store option as well. Okay.
Absolutely.
Yeah. So last question, and I sort of meant to ask this earlier, but the Afterpay investment with Square coming in, and I mean I know the acquisition of by Square is not going to close until next year,
Yeah.
but how does that impact you?
I mean, in the short and midterm and the long term are two different things. In the short to midterm, looking at 6, 9 months, however long it closes, it doesn't. I mean, it really doesn't have any impact on us. We're extremely excited for the long term, what could happen from that acquisition and who our partners could be. But for the time being, we focus on rolling out in the region, on winning the market, and on serving our customers.
Okay. Well, we'll have to leave it at that. We ran a little long, which is fine. It was a good conversation. The beauty of
Fantastic.
podcasts is there's no real hard limits, so it's all good. Yeah, well, thank you very much for your time. Really appreciate it. Really enjoyed the conversation and learning a little more about
Likewise.
post pay and this industry, which is really exciting. So thanks again.
Thanks for having me. Thanks a lot.